Hi YouTube, it's Janelli here, and in this video we're going to be breaking down compounding and how it works in the stock market. Now I know that whenever you hear the words stock market or even investing or credit cards or saving, budgeting, anything related to personal finance, it can seem really scary and complicated, but it's really not. So that's why I post videos every week to help break it down for you so you can see that it is not as complicated as it might seem. And in this video we're going to be talking about the difference between compounding interest, which you earn when you have a savings account, and compounding, which happens in the stock market. Now, they both have the word compound or compounding, which makes people think that they're exactly the same. Myself included, like I used to think that you can say compounding interest for the stock market and it was the same thing, but it's slightly different. And so I'm gonna explain the difference here. We'll start with compounding interest because that's the one that's most common. People usually, if they have a savings account, they know that when you put money in there, you get paid free money from the bank, which is called interest. They pay you a small amount of money to basically incentivize you and to reward you for putting money in their bank instead of somebody else's bank. Now, interest is generally not that high when it comes to earning interest on a savings account. So it's really hard, especially now in 2019, to find something more than like 2.5%, which is really not a lot. Percent means out of every $100 that you invest. So if you put $100 in the bank account, in your savings account, and you don't touch it, you're so good. You leave it there and you let it save up and you just let it sit there. At the end of the year, if you leave it for one whole year, the annual interest that you will earn is 2.5%, which is $2.50. So your $100 now, your account will be $102.50. Now that doesn't seem like a lot of money, especially because you have to wait a whole year for it. But trust me, it's better than getting $0 by letting that $100 sit in a checking account for that whole year instead. So you do want to be saving, and you want to try to get as much interest back as you can. So most of the time, experts in personal finance will say, get a high yield online savings account because those are the savings accounts that give you more than 2% nowadays, which is true. Like I use online savings accounts because I think that, it's better to get $2 than to get 5 cents for every 100 that I save. But the reality is that when you invest in the stock market, you are not getting paid interest. What's happening when you put money in the stock market is that the price of the stocks that you're investing in, ideally, those prices are going to go up over time. Every time the price goes up, let's say about 10% in a year, or if it goes up about 10% every year, then that's how much your investment is going to grow because the price of the stock that you bought increased. So here, let's go through an example because I know that probably sounds a little confusing. Let's say that you bought, 1 out of 10 pieces of my company at the very beginning when it wasn't very big, nobody had heard about it. It's, small startup. So you own 1/10. That means that you have 10% of the company's whole worth. But right now, since it's a company not a lot of people know about, it's not worth a lot. But then if you wait, let's say 5-6 years, the company blows up and we go public, which is what they call it when you put your company as a available stock to purchase on the stock market. Now you go public, my company goes public, and you own 10% of it. So people start buying small pieces of the company, and the company is just getting bigger and bigger and bigger in terms of how much it's valued at, in terms of how much that company is worth. It used to be worth not a lot. Now all of a sudden, everybody wants to buy a piece of the company. It's a popular company. It's growing, and the brand is well known. So now 10% of my company is actually a lot more dollars than it used to be, right? So if my company used to be worth $100, then you own 1/10. That means that your how much you own in my company is worth $10. But now the company is worth, $100,000, then your piece of my company is now worth $10,000 instead of just $10. And that's just because the company's value grew so much. How much your stock is worth in my company increased with that. So it's really important to think about if the price changes, that's where the growth is coming from. And that's called return on investment, which a lot of people call ROI. So if you've ever heard ROI, then you know ROI means return on investment rather than the return that you get from interest on savings, which are very different. So once you kind of understand that, how do you figure out how much you're gonna get, what return you're gonna get? The rule of 72 is great for this. This is like the perfect way for anybody to kind of project. Now, it's not perfect math and it's not always gonna work out exactly to the decimal points, but it gives you a pretty good idea and a good estimate of how you can project your money out into the future. Let's look at an example of like how the rule of 72 would work, right? I have been using a savings account, an online savings account that gives me 2% every year when I invest. So I put $100 into my savings account. At the end of the year, it's going to be 102. Great. I just earned $2 for free. That's interest. Now, the rule of 72 says if you take the number 72 every single time, it's just the Rule 72 means the number doesn't change. You take 72 and you divide it by the return that you're expecting, which with the savings account, that's 2% return. So 72 divided by 2 is 36. That means that my money that I have in my account is gonna double. My investment, my $100 that I put into the savings account is gonna double in 36 years. That's right. I gotta wait 36 years for my $100 to become $200. By that time, I'm gonna be ready to retire and I'm only gonna have $200. That's crazy. So that's how you know that that's not a really good way to build up wealth for the long term. A savings account is a really great way to just have money right here when I need it, but it's very clear when you use the rule of 72 that it's gonna take forever for your money to double. So if you want your money to double faster, you have to get a higher return than just 2%. So now let's look at an example from the stock market. When most people think of the stock market, they think of the S&P 500, which is the 500 biggest companies in the stock market. Now, when you look historically at the performance of the S&P 500, like how has it been doing? How much did it grow every year? It's very different year by year. Some years it grew by like 35%. Another year maybe only 10%. Another year maybe it went down 4%. Maybe then it went back up again 12%. So it's really hard to tell, like, because it's not the same every year like a savings account. It's not like a guaranteed fixed same amount of return every year. And that's what makes it hard to project. But what people like to do is they take the average. Just like your GPA in school, when you take the average of all your classes, take the average of all of the years, right? So add up all the performances, negative, positive, whatever they are, and take the average. So historically, if you do that, the S&P 500 has been around 8 or 9%. Let's go with 8% so that we're a little bit more conservative in this example, right? We're playing it safe. So let's say you're gonna predict that it's gonna continue to be the way that it's always been for the past, decades and decades of time. Now you're gonna say, all right, I'm gonna plan for 8% return. 72 divided by 8 is 9. So that means every 9 years, the money that you invest into your S&P 500 fund, index fund hopefully, is going to double every 9 years. So I put $100 into the S&P 500 index fund, and now 9 years later, I have $200. That is way better than 36 years I have to wait to get $200 from my original investment of $100. So with the rule of 72, you can see that the higher the return that you can expect, the much faster it's gonna be for you to double your money. And the whole point of building wealth is to continue to double how much you have, triple it, quadruple it, make it as many times more as you possibly can, because that's how you build wealth. You continue to make your money grow and grow and grow. So hopefully now you understand why you do not earn interest, compounding interest in the stock market. It's actually just returns on investment. And why you do earn a fixed, steady, consistent interest, compounding interest from a savings account, but it's really just not that great of a return. And that's, again, because, it's pretty safe. They guarantee that your money's gonna be there every single year, and there's not gonna be ups and downs. It's the same 2.5 or 2% that you can expect every year. Versus the stock market, there's no way of telling how it's gonna perform each year, but we can rely on that historical data and take a clean average over 30, 40 years to say, okay, let's start playing around with these numbers. Let's use that as a prediction for now, and then maybe plan for a little bit less just in case, not plan for more. Always plan for a little bit less just in case. So if you overshoot and you project too much, you might end up with not enough money, versus if you undershoot, if you project for a little less and you have more money, great. That's always nice to have extra money. But you don't want to plan for like 10% return in the stock market, because the reality is it might be a little less. So you always want to use conservative numbers. I like to do 7%, 8% when I'm doing my projections, rather than 9 or 10%. I just feel like that's too aggressive. If you guys have comments or questions about how compounding works with the stock market versus compounding interest in a savings account, put them below in the comment section. You can also email me at MissBeHelpful@gmail.com. I always make sure to try to respond to those emails in a timely manner, though I do get a lot of emails, so be patient with me. And then if you have a question that you want to call in and leave as a voicemail message, I have a Google Voice number, and I will listen to it, and then I will post it in a video response that I'll post right here on my channel. So that's another option as well. Find me on social media and reach out to me. I love to talk to people that watch and subscribe to my videos here on YouTube. And that's pretty much all I have for you guys. So till next time, peace.